to daily later. We will wait just a minute to get started here. Today, we're going to be pulling some live mortgage rates and we're going to do a deep dive into manufactured homes, which is our topic today. But we'll wait just a couple of minutes to get started here so we can go live on all the platforms. We are streaming this live on YouTube, Facebook, and LinkedIn. So give us a second to go live on all the platforms and give everybody a chance to tune in. We appreciate everybody jumping on early. Feel free to drop a comment there. We do have the chat up on the screen. So as you tune in, drop a comment there. We appreciate it. And we'll get started momentarily. Hope everyone has a great weekend and is ready to get back to it today on a Monday. Thank you for dropping the comments there, Victoria, Warren, Richard. Appreciate it. Feel free to keep dropping comments, but looks like we are ready to go. So we'll go ahead and take the chat off the screen. Gloria, Jake, appreciate those comments. And it looks like we're ready to get started here. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do every morning on this show is go through some live mortgage rates of different programs. And then we do a deep dive into a different topic every day. Today's deep dive is going to be manufactured homes. Now, not only are we going to pull up some rates on manufactured homes, but our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and a realtor, is also going to talk about what is and what is not a manufactured home, which is definitely something that gets confused a lot in this industry. So we're going to do that deep dive here momentarily, but before we do that, we'll do what we do every morning, which is go through the live mortgage rates. So Nick, let's go ahead and pull up our pricing tool and see what the market is looking like today for the rates.
All right, let me switch my screen and we will get started. So this is our pricing tool, as Kyle explained, for our mortgage professionals. This will show us the general rates and the APR, including all the fees. For today, it is August 14th, just after 11 a.m. Eastern, so all of our general programs are live. If you'd like a full breakdown of all the fees that go into the APR, a full loan estimate, please get one of our team members. We have over 300 licensed loan officers in 24 states for primary and second homes, and we can do our business purpose DSCR loan in 44 states total. For today, to compare across the different programs, we will set up the same scenario so we can compare across the programs on their APR. So we'll set a loan amount of $400,000. We'll set an LTV of 80% loan to value, 20% down payment for all our demos. We'll set the desired price to $99. That means we're going to ask the computer for the best rate at one discount point in cost. We will compare our programs. We'll start with conforming conventional, then we'll check out our FHA rates this morning, and then we'll go into expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs we offer that can use alternative income. We also have VA and USDA. Remember, VA is only for our eligible veterans and active service members. If you do happen to be eligible, let us know. We can quote it, no problem. And same with USDA. That's only for properties that are eligible in a USDA rural area. So if you do happen to be shopping there, let us know. We can quote it, no problem. Start today with conforming conventional. We'll do purchase, 30-year fixed standard loan for all our demos, primary occupancy, single family home, 1 unit, state of Florida, county and Miami-Dade. And for all the demos, we use an estimated FICO of 760 and an estimated debt to income ratio of 40%. So with these settings, as we do every morning, let's check the conventional rates. Ooh, and definitely jumped a little bit here with all the news. 7.375 rate, 0.75 discount points at cost, puts our final APR just over 7.533. So this is the option here for our customers that qualify for conventional. But if our customer has any trouble qualifying for conventional, usually the next option we want to look at is an FHA program. So let's pull up the same exact scenario. 80% loan to value. Everything else will stay exactly the same. all we're going to do is change to FHA here so we can compare exactly across the programs. So let's check out the FHA options. So FHA went up a little bit as well, 6.625, 0.75 discount points in cost, puts our final APR at 7.209. So just a touch under conventional. So for our customer that qualifies for both, as it has been for the last few months, the FHA is actually a touch cheaper if you qualify for both. Our customers that must use FHA for the credit leniency and the higher debt to income, which is usually the reason to use an FHA program, will definitely benefit from these recent changes. So good option here for our customers out there looking for a good option. But many times our customers have trouble qualifying for either conventional or FHA, and that's where many other banks or lenders leave them hanging. But not here at the Mortgage Calculator. We specialize in non-QM, and that's also called expanded guidelines. So if we select this option, we'll have 5,000 loan programs beyond FHA and conventional that we can offer our borrowers to solve their problem. So everything else will stay the same, but the first option we must select for non-QM is the income type. So full doc is what we use for FHA and conventional. That's 2 years of tax returns. So the reason to select this program is typically to use one of the other options, such as our asset-related programs, business bank statement programs, our investor programs we'll talk about in a minute. Our personal bank statement 12-month is the most popular one. That's what we use for the demo. We also have RSU, stated, VOE, 1099, P&L, and no income CDFI options. So tons of options here, but the most popular is the personal bank statement 12-month. And that's for our self-employed borrowers. Many times our self-employed borrowers, when they have 2 years of tax returns, will have various write-offs and may not qualify at all, or may not quite qualify for as much income as they really need to get the home they want. So in this case, instead of using tax returns, we're simply going to use their last 12 bank statements, no tax returns involved at all, and determine a debt to income ratio of 40% in this example, using just their cash in the bank statements, no tax returns. So most of the time, our self-employed borrowers qualify for double, triple, or more of the income using this method, and can therefore qualify where they would not qualify before. So these non-QM solutions are amazing for our customers that need a little bit of extra help. So let's check out the options this morning. So very comparable here, 7.5 rate, a little bit higher cost. Obviously, these are specialty programs, 2.75 discount points in cost, but that puts our final APR at 7.625. So remember, conventional was at 7.533. We are within 0.1% now. This is probably the closest we've ever been since we've been doing this live rate show. So right now, a bank statement option is almost identical to a conventional option. So this is where we love to shine here using these alternative methods. Obviously, this is a great option. Some of these ones down here, a little bit higher rates, may allow things like bankruptcies and foreclosures and other types of credit events, which would otherwise disqualify our customer. So there's dozens and dozens of different options here to use bank statement income. Some of these may allow us to get around some other guidelines as well. So please get with our team. They will find the best one for you. Now, before we go into Jose's example, we always do live pricing for investment properties. So we'll do our final 2 demos here for an investment property. Set up the same scenario, 80% loan to value, 20% down payment. And we'll simply compare our 2 options for investment properties. We have conventional options, and we have our non-QM expanded guidelines options. Remember the government programs, FHA, VA, USDA, not eligible for investments. So we'll start today with conforming conventional. Everything else will stay exactly the same as all our other demos. The only thing we've edited here is the occupancy to investment. So let's see the pricing adjustments conventional has for investment properties. And a little bit spendy here, 7.5 rate for 4 discount points in cost, and our final APR 7.767. So unfortunately, this would probably not even be a legal rate to sell at 4 discount points of cost. That's quite a bit of cost, and most of our investors would not like to pay that, right? $16,000 is a lot of money in our demo here. So most investors that are looking to purchase an investment property want other options at maybe a higher rate to reduce these discount points. Unfortunately, conventional has limits right now where they're basically adding these adjustments to investment properties that make it not really feasible to use these programs. That's where we love to present our non-QM options. So I'll set up the same exact scenario, investment property, 80 LTV, and we will select expanded guidelines, also known as non-QM. And first thing we must pick is our income verification. Our most popular option for an investment property by far, and our most popular loan by far, is our DSCR loan. That's because it doesn't require any income or employment from our borrower. We simply use the estimated rental income to determine a DSCR. It stands for debt service coverage ratio value. So if the estimated rents from the property can cover the PITIA, the mortgage expenses of this mortgage we're proposing, that is a ratio of 1.00 or higher, aka the property cash flows on a monthly basis. We even have options for properties that do not quite cash flow on a monthly basis, aka that ratio is under 1.00. So tons of different options here. I'll always put 1.5, which is the highest value. That way we can see all the different options pop up here. And finally, we need to select the prepayment penalty. 3 years is standard for non-QM investment properties. However, we can select 0 if we wish. That will cost more and limit our loan programs. And we can select 5 years if we wish, which will again limit the loan programs, but save our customers some money. 3 years, however, is the standard, so that's what we always select for our demo. So let's check out the DSCR options. 8.125 rate, 0.725 discount points and costs. So we've solved our problem for our investor here to lower the discount points. And a final APR of 8.182. So great option here for our investors, especially after today's show. When we're here within less than half a point of conventional, I'd say 90%, probably even 100% of the investors that are presented with these two options today are going to choose a DSCR option for the flexibility. Also to obviously save the discount points. 2,900 is a lot less than 16,000 in our other example, and a lot of other benefits as well. Some of these down here at a little bit higher rates may allow bankruptcies and foreclosures and other types of credit events, and some of these at a little bit higher rates may allow things like short-term rental income, very popular request from our customers these days. So tons of different options here. Please get with our team to find the one that fits best for you. Now let me switch my screen and we'll get into our deep dive for today, which is a pretty cool option. We're going to be talking about manufactured homes. So not mobile homes, which Jose is about to explain here in a second. We're talking about manufactured homes. And usually that means double wide manufactured homes is typically the standard here that we're looking at. But I'll let Jose go ahead and explain more about the quotes that he set up. And hopefully we have some of our cool options for non-QM manufactured, as well as our standard conventional FHA type of options. So Jose, if you got some examples ready, let's go ahead and check it out.
Good morning, everybody. How you doing? Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Great to be with you here this morning. Well, first, I'd like to lay down a little groundwork on what a manufactured home is and isn't, because there seems to be a lot of misconceptions, a lot of nomenclature differences, let's call it, right? Most people tend to refer to manufactured homes as mobile homes, right? And that's one of the big issues, because if you are inquiring about a mobile home, that's not something that we would do a regular FHA or conventional or non-QM mortgage loan on. We would not be able to originate any type of those loans on a mobile home, because a mobile home, I guess, is basically a manufactured home that is not permanently affixed to land, right? It is still living its life as a vehicle, let's say, with a vehicle title. Once a mobile home is permanently affixed to land, it then transitions to being a manufactured home, and then will be assigned a regular title, quote unquote, like every other home. It will have a folio number. You'll be able to look it up in public records as you would be able to look up any other type of home, right? The difference is that it's going to be a manufactured home instead of a frame and stucco home, or a concrete block and stucco home, or a modular home. Now, there seems to be also some confusion with calling a manufactured home a modular home. Modular homes are pre-manufactured at the factory, The different walls could have the plumbing and the electricity already running through the walls, and then the different pieces are brought to the site and are assembled. The same way you're going to assemble a stick-built home, let's say, frame and stucco, or a concrete block home. It's just assembled in a different manner, but it is from the inception permanently affixed to the land. Whereas a manufactured home usually comes from the factory on a trailer with wheels in one or two pieces, depending if it's a single wide or a double wide, and then it is put together at the job site and then permanently affixed to the land. And then certain affidavits are provided to confirm that it is now a manufactured home and not a mobile home. So the first thing to note is please do not call a manufactured home a mobile home. Right, that'll confuse everybody, and maybe the loan that you would be able to originate would not be originated because of that confusion. You would be told, oh no, we can't lend on a mobile home. You think the deal is dead, and the only reason that the deal was killed was because somebody assumed that you were talking about a mobile home and not a manufactured home. So, manufactured homes are very popular now, more than ever, because of the rapid increase in prices of all of the homes. A lot of people have been priced out of being able to qualify for a regular quote unquote home. So now they're seeking manufactured homes. Manufactured homes can be financed through FHA, conventional, or non QM. The best options for a manufactured home will be through FHA. However, please note that when you do go FHA for a manufactured home, there is a required structural engineer's report, basically confirming that the condition of the foundation of the home. There are also HUD data, plate and decal expenses that have to be considered. So take those items into consideration when disclosing the expenses of a manufactured home. In conventional and FHA loans, investment is not possible. So you cannot have an investment purchase nor refinance, conventional or FHA, but you can originate that investment manufactured home loan via the non QM route, even going DSCR. And our investors love those manufactured homes because the rents are usually very high compared to the cost. So they get a good cash flow on the property, aka a good DSCR. So let me share my
before you start though, Jose. So all of these are double wide quotes, I'm assuming, unless you otherwise noted.
Yes, these are all double wide quotes. Now, single wide is possible, but it does vary from investor to investor because, as we all know, they may put their own overlays in there, and it does obviously affect the pricing. So, what I am quoting here is something that would be a double wide that would be built after 1976, which is the cutoff year. Prior to 1976, we would not be able to offer financing for any manufactured homes, right? So keep that in mind. And there are also minimum size requirements. So you would have to look into the guidelines to make sure that the home is large enough in square foot of living area to qualify for the loans. So our first example here is a manufactured home purchase with only 3.5% down. You get all of the same benefits of a regular FHA loan, right? Low down payment, good rates. But like I did mention, keep in mind there are some additional expenses, especially when going FHA. The structural engineer's report is not an immediate requirement on a manufactured home loan. However, If the appraiser, when the appraiser goes out to the property, if they make any notation about possible issues with the foundation of the manufactured home, then obviously you will be conditioned for this structural engineer's report, which could be $500, $600, $700. So here in this case, we're looking at 7.125 as your lowest cost option and 6.25 as your lowest rate option. You will note that there is a little bit higher cost at the 7.125 than you would note for a traditional FHA loan, but that is because of loan level price adjustments due to the fact that it is a manufactured home. So this is our FHA 3.5% down purchase. So now we do have a first-time home buyer 3% down manufactured home option under a program called the Manufactured Home Advantage Program. Now, this program does require the manufactured home to be no older than 1990.
And so, this is a conventional program,
yes, sir.
I'm assuming. Okay.
Yeah. So this is 3% down, conventional. So if you are going for this option, when you are pricing it out, make sure that the year built of that manufactured home is no earlier than 1990. So here you have 7.625 at roughly the same cost that we had at 7.125 for the FHA loan, like I mentioned, but different loan product. 7% down is your lowest cost option with a pretty good cost there. So that's our 3% down first time home buyer manufactured home option. Now we have the Freddie Mac Choice One program, which is another similar program to the Fannie Mae Manufactured Home Advantage program. This is just a Freddie Mac option. Now, why would we have a Freddie Mac and a Fannie Mae option? Well, you all know that depending on your borrower type, for example, we like using Freddie Mac for our self-employed borrowers because of the way the self-employment income is analyzed under the Freddie Mac guidelines. It's more lenient, easier to capture more income for your self-employed borrowers under Freddie Mac. And also, obviously, when you're running your automated underwriting, sometimes you don't get the automated underwriting approval under Fannie, and sometimes you get it under Freddie, and vice versa. So it's good to have options. So now we even have, believe it or not, a one-time close program for manufactured homes. Now, yes, what would be the construction on it? Well, the construction on it is that it's built at the factory, right? And in the one-time close program, you can actually buy the land with the program and then have them install the brand new manufactured home on the site, go through all the different steps to certify that it is now a home instead of a trailer, and then have your deal. And so you have the same benefits for the one-time close program with manufactured homes that you would have with regular stick-built homes, in that we have inventory shortages throughout the country. It's tough to get already built homes, including manufactured homes. Everybody's going crazy with the prices. So this would allow you to buy that piece of land, buy a brand new, spanking brand new manufactured home, have them install it on the lot, and be the first one to use it. So again, one-time close for manufactured home with 5% down payment. Now our manufactured home conventional purchase with 5% down. You will note that the rate are a little bit costlier than they were under the manufactured home advantage. The other one had $24.25 cost at 7.625. This one has $33.25, and it's a 5% down option instead of a 3% down option. However, this one allows you to have manufactured homes older than 1990. The other program limited it to 1990 or newer, hence less risk regarding the property, because manufactured homes do have a little bit more of a limited life expectancy than a regular built home, due just to the nature of their construction. So now here are some other differences real important that you needed to note on manufactured homes is cash outs. On a conventional cash out, the maximum amortization is 20 years.
So that's why they're not getting hits on it unless they change the
Yeah.
amortization. So make sure you guys.
Yeah, 20-year maximum amortization. And you will note here the loan amount. This is the max loan amount of 260, which is 65% loan to value. So maximum amortization is 20 years, maximum LTV 65%. So that's what I was stating, where FHA would usually be a little bit more lenient on the manufactured homes, because here, yeah, I mean, the rates look okay, right? 7.625 as your lowest cost option and 7% your lowest rate option. But again, that's 65% and a 20-year amortization. So if you are going to do that manufactured home cash out, your best option will be FHA. Good old FHA lets you take it up to an 80% LTV.
And that's 30-year.
30-year amortization, correct. And look at the rates there, right? Pretty good. 7.625 is your lowest cost option, 6.5% lowest rate option. You will note, obviously, these rates are better than your FHA purchase, which was done at 96.5% LTV, because at an 80%, you're going to be getting a break on the rate. But still, the issue that sometimes turns our borrowers off is that FHA will always have mortgage insurance present. When you do have a 90% or lower LTV, you are able to remove the mortgage insurance, but you have to wait 11 years before you can do so. But if it's a cash out manufactured home that you're looking for, this is pretty much the best option for your primary occupant. Now let's, yeah.
Real quick, the no 100%. You want to touch on that real quick?
No 100% in terms of
cash out FHA. Remember that it's even more strict here, correct?
Yeah.
The FHA, remember, we had 90 on a regular. You're at 80 on a manufactured, even though the guideline says 100.
Well, right? The guidelines, on FHA are very liberal, right? FHA, for example, doesn't have a minimum FICO score, but the investors and lenders add their own overlays. That's why we have FHA guidelines, quote unquote, all over the place at the different investors and lenders that we use, because that is their overlays. So you get some that say, sure, we'll do it. Most of them right now, anyhow, are capping the cash out on FHAs at 80% because they choose to do so. They want to have a sellable product in the secondary market, because even though FHA allows you to go to, zero FICO score, that doesn't mean that if they have a whole set of nice packages with super low scores, that they'll be able to sell that package at the price that they would need. So something to be aware of on that is be aware of the overlays. So here on our cash out, 7.625 is our lowest cost option and 6.5 lowest rate option. So now I'm going to jump right to the most exciting part here is DSCR, manufactured home options. We at the Mortgage Calculator actually do have an option for DSCR, manufactured home purchases. This is something which is going to really excite your investors out there that love the rent to cost ratio on these manufactured homes. Obviously, rates are a little bit higher, but that's really not going to deter your investor on doing this loan. Now, it is maximum 70% LTV on the purchase, but you're talking about a DSCR purchase of a manufactured home. Now, I'm sure it's going to have a good debt service coverage ratio at a 70% with the kind of rents that you can get for these manufactured homes compared to the price. Now, here in our example, I'm obviously using a high price, $400,000. But as an example, this is a great option for manufactured homes in resort areas like the Florida Keys, where you have a lot of manufactured homes. I mean, the majority of the homes that you're going to be able to obtain in the Florida Keys under $1 million are going to be double wide manufactured homes. So here was 30% down, you can do the deal. 10.625 lowest cost option, and 8.99, which is a darn good rate, lowest rate option. And then
So before you go into that, Jose, can you purchase a manufactured home for an investment property using any other program?
yes, we do have non-QM. We can go bank statement.
What about FHA?
No, FHA. No, I mean, for FHA, it's always going to be primary. Conventional, no option. As a matter of fact, on a conventional, if you do a cash out on a manufactured, if you do a refi, excuse me, on a manufactured home, it has to be primary or second home only, and it cannot be a cash out. It's rate and term only on the conventional loan. So the only one that is going to allow you to do the for investment, that option, cash out or purchase, is going to be non-QM, where you can do all of the income streams. You can do full doc, you can do bank statement, you can do P&L, you can do asset utilization, or you can do, as I'm mentioning here, the DSCR. It's just that time didn't permit to go into 4 or 5 more quote options, but you can do the whole spectrum of income types, non-QM, manufactured homes, both primary, second home, and investment. So our most
So this is one of the products where non-QM really comes in handy.
Okay, here, and unfortunately my rate did not populate on my DSCR quote, but you can do it at 65%, and you're going to be looking at the same rates that we're looking here on the purchase, but instead your LTV is 65% DSCR, cash out refi manufactured home. So for those of you out there looking for your cash out refis for your investors on the DSCR options, we at the Mortgage Calculator do have that very unique loan. I'd almost compare that loan to a unicorn.
All right. And we got one question from Levine here. I think you kind of covered it, but let's just go over again the difference between chattel and manufactured home, so they can help explain to the borrowers. I guess she wants a little advice on how to explain that to a borrower.
Well, the main thing to note first is you have to make clear to your borrower the difference between a mobile home, which would have a chattel loan, and the manufactured home, which would have the regular type mortgage loans, whether it's FHA, conventional, or non-QM. And the difference is that the manufactured home is permanently affixed to the land. It is no longer considered a trailer, whereas the mobile home basically has a vehicle trailer title because it is not permanently affixed to land that is associated with it. It could be sitting in a trailer park or a mobile home park affixed to a piece of land, but that land belongs to the trailer park. It does not belong to the owner, and it is not associated with the mobile home, because if it was, then you would be able to find it in the public records under a folio number, which would describe the land size, so forth and so on, and it would describe that it has a manufactured home on the lot.
Interesting point there. A manufactured home can be attached. That doesn't mean it has the correct title, right? So just because someone's took it off the wheels doesn't mean that it has a title change that occurred. So that's a good distinction for your borrowers. They might not understand that, but do your best to explain that for sure. And we got one more question here from Christian. This is actually a good question. What happens if there's an HOA? What happens if the manufacturer's in a condo association, like is probably common in the Florida Keys, as you mentioned there, Jose? That poses some other challenges, I'm sure.
Well, yeah, at that point, you really have to look at eligible and ineligible property types because that may disqualify it being um, from being eligible for the loan, right? And then at that point, you're going to have all sorts of other considerations to run, including your condo questionnaire. But I would strongly suggest that if it is subject to a condo association, it would be considered a detached condo. So those are different requirements than regular quote unquote condos that are in a building. So I would strongly suggest you look at your guidelines and make sure that it fits for that program.
So PUD may be eligible, but condo would pose more challenges, it sounds like.
Yeah, because of the increased risk factor associated with condo ownership, associations, budgets, and all those things that have to be taken into consideration that could affect the resale value of the manufactured home. So not only would you have to worry about just the property type causing risk, but now you add the additional risk of association ownership, association financial health, and poses all sorts of risks on it. So look into your guidelines deeply if you do have that situation.
Never heard of that before, but it seems like it could happen. So good question.
All right. I don't see any other questions, so I think we can wrap it up. Great training here today. Thank you, Jose. Remember, everyone, we do this show at 11 a.m. Eastern every single weekday where we go through the live rates and then do a deep dive into a different topic. If you need to connect with one of our loan officers, we have over 350 loan officers all around the country. You can visit us at themortgagecalculator.com, and we can pair you up with one of those loan officers. I appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. Thank you, everyone, for the questions. And we hope to see you all tomorrow at 11 a.m. Eastern for the next episode of Daily Rates Live with the Mortgage Calculator. Everyone, have a great day.
Thanks, everybody.
Thank you, everybody.